Hey everyone, so imagine for a second you could trade the markets without any of that gut-wrenching emotion. No hunches, no feelings, just pure, cold, hard data. Well, that's exactly the promise of quantitative trading. It's this amazing world where math, finance, and serious tech all smash together to find profits hidden in plain sight. And today we're going to pull back the curtain and see exactly how these quants make it happen.
So let's start with that big central question. Seriously, what if you could just strip away all the fear, all the greed, all the intuition from investing, and replace it all with pure, cold, hard logic, where every single move is driven by a proven statistical edge? That's really the core idea we're going to unpack.
And this brings us to the formal definition. At its heart, quantitative finance is all about using super powerful math and just enormous data sets to make sense of the markets. The people who do this, we call them quants, and their entire job, their whole mission, is to find these profitable, repeatable patterns that are just hiding in all the market's noise.
Okay, so how does this all actually work in the real world? Well, any professional quant system is built on these four essential pillars. You got to start with an idea, right? That's strategy identification. Then you test it against history. Then you build the tech to actually trade it. And finally, you manage your risk so you can stay in the game for the long haul.
So that's our game plan for today. We're going to walk through each one of those four pillars, step by step. We're going to take a strategy from just a simple idea all the way to a live system trading in the market.
All right, first up, Pillar 1, finding an edge. Now this is the creative part. This is the hunt for a genuine statistical advantage, something you can exploit over and over again for profit. You know, when you boil it all down, almost every quant strategy you'll ever see falls into one of two big buckets. First, you've got mean reversion. This is kind of like betting on financial gravity, right? The idea that a stock price that shoots way up or drops way down is eventually going to get pulled back to its average. And then you have the total opposite, momentum. That's just betting that a trend that's already in motion is going to stay in motion.
To really get mean reversion, you have to understand this one core concept, the law of one price. It's the theoretical bedrock. All it really says is that two very similar things, say two giant banks, should have very similar prices. When they don't, it creates this kind of statistical tension, right? An imbalance that the market sooner or later is going to want to correct.
And here's how that theory becomes a real live strategy. It's called pairs trading. You find two stocks that historically just move together, like they're tied by some invisible string. Quants have a fancy word for this. They call it co-integration. Now, when their prices drift too far apart, the model jumps in and bets on them snapping back together. It'll short the one that's gone up too much and buy the one that's lagged behind, basically profiting when that gap between them closes.
Which brings us right to Pillar 2, the reality check. I mean, having a clever idea is great and all, but does it actually work? This is where you have to stress test your strategy against the brutal, unforgiving history of the market itself.
And this whole process is called backtesting. You're basically running a simulation. You're going back in time and seeing if you would have actually made money. Now, the super important thing to remember here is that this isn't about guaranteeing future success. No way. It's about setting realistic expectations and finding all the fatal flaws before you risk a single real dollar.
But backtesting is absolutely filled with traps. And let me tell you, this is the most dangerous one of all, survivorship bias. It is a subtle but absolutely fatal error that can make a totally terrible strategy look like a stroke of genius.
In this table shows exactly why it's so sneaky. A biased backtest, it only uses data from companies that are still around today. You know, the survivors, the winners. It completely ignores every company that went bust, got bought out, or just disappeared. So of course it looks amazing. But a realistic backtest, that includes all the dead companies, all the failures, and yeah, that gives you the real and usually much, much less exciting truth about how your strategy would have actually performed.
And survivorship bias isn't the only monster hiding in the data. Oh no. There's look-ahead bias. That's like cheating on your test by using tomorrow's newspaper. There's optimization bias, which is basically torturing the data until it confesses to a profit that was just random luck. And even simple stuff, like forgetting to adjust for stock splits, can totally invalidate your entire test.
Okay, so let's say you found an edge, and you've somehow survived the backtesting gauntlet. Now it's time for Pillar 3, going live. This is where the theory from the lab gets plugged into the chaos of the real-world market.
You do this through what's called an execution system. Think of it like the technological bridge that takes the signals from your strategy and turns them into actual buy and sell orders at a brokerage. And for pretty much anything that trades more than a few times a day, this entire process has to be 100% automated.
Now, the second you go live, you face these real-world profit killers, transaction costs. I mean, there's the obvious stuff like commissions and fees, but there's also the bid-ask spread you have to cross on every single trade. And then there's slippage. That's the market moving against you in that split second between when you send an order and when it actually gets filled. These tiny little costs can absolutely bleed a profitable strategy dry.
And when you get to the really extreme end of the spectrum, with high-frequency trading, HFT, the technology is the strategy. The game is won or lost in microseconds. And this means you need custom-built systems, often written in high-performance languages like C++, just to minimize any possible delay. At this level, your skill as a programmer is just as critical as your skill as a statistician.
All right, this brings us to the final, and I would argue the most important pillar, risk management. A great strategy can find you profits, for sure, but a great risk system is what allows you to survive long enough to actually keep them. It is all about protecting your capital.
A key tool that all the big institutional funds use is something called value at risk, or VAR. It's a statistical calculation that answers a really simple question. What is my worst-case scenario? So, for example, a VAR of $1 million at 95% confidence, that just means there's only a 5% chance of losing more than $1 million on any given day. It sets that hard, statistical line in the sand for risk.
But, beyond just defining your worst-case loss, there is one single number that serves as the ultimate report card for any quant strategy. It is the metric that quants obsess over more than anything else. And that metric is the Sharpe ratio. It is the ultimate report card because it doesn't just ask how much money did you make. It asks how smoothly did you make it. Think about it. A strategy that makes 10% with this wild, stomach-churning ride is way worse than one that makes 9% calmly and consistently. The Sharpe ratio measures exactly that, the quality of your return.
So, what's a good score? Well, a Sharpe ratio over 1.0 is the classic benchmark for a really solid strategy. And the higher, the better. It is essentially your strategy's bang for your buck score. It's proof that you're being well rewarded for the risks you're taking.
And ultimately, this is what everyone in the quant world is chasing. A high Sharpe ratio doesn't just mean profits, it means quality profits. The visual result is this beautiful equity curve that just slopes smoothly and consistently upwards, with very few, very small dips or drawdowns along the way. That right there, that's the holy grail of quantitative trading.
So there you have it. We've walked through the entire process, finding an edge, stress testing it against reality, building a machine to trade it, and managing the risk to survive. This whole scientific discipline has completely reshaped finance, which of course leaves us with the biggest question of all. As the models get smarter and the machines get faster, where does the human trader even fit in anymore?